Hello, I'm Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Nate Ekman and Alan House. Today we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and finally answer your questions. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The Federal Reserve reduced the benchmark short-term interest rate by a quarter point at the December Federal Open Market Committee meeting. It marked the third consecutive cut by the central bank and brought the Fed funds rate to a range of 3.5 to 3.75%. This level is closer to what would be considered a neutral rate, meaning it's neither stimulating nor slowing growth, and continued the bank's less restrictive monetary policy course, which now includes buying back Treasury bonds. That quantitative easing program increases liquidity in the economy. The Fed believes the balance of risk has shifted to the employment side. Recent data, including an uptick in the unemployment rate to 4.4%, suggests that the labor market is softening. True, the pace of corporate layoffs is still not indicative of a very weak jobs outlook, but the recent lack of hiring shows that employers are becoming more cautious. This development seems to have caught the Fed's attention. The central bank's monetary policies will remain in focus. That is because Chairman Jerome Powell's term as Fed leader will end in May. Reports suggest that President Trump has made his decision on a successor, but that person remains unnamed. The next chairperson is likely to promote a more accommodative monetary policy stance, pushing for further cuts to the Fed funds rate, the level at which banks borrow and lend their excess reserves to each other overnight. This can influence broader interest rates for consumers, businesses, and the U.S. Treasury itself, impacting everything from credit cards to mortgages. U.S. consumers are proving resilient, but there are signs of underlying stress, particularly at the lower income level. This has created a K-shaped economy where those at the bottom suffer price inflation at a time when those at the top are experiencing asset inflation. On the positive side, the September Personal Consumption Expenditures PCE price index did not reveal a meaningful increase in the prices in prices due to tariffs, and the preliminary December Consumer Sentiment Index did show a modest improvement in the mood of consumers. In conclusion, the stage, which includes the Fed cutting rates into what appears to be a re-accelerating, albeit bifurcated economy, may be set for another late-year Santa Claus rally. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our print and digital subscribers depend on our weekly stock reports, time-tested ranking systems, and other valuable services. To that end, we're constantly working to improve our offerings in order to ensure the best possible experience for our subscribers. Our latest innovation in that regard is the Value Line digital booklet, which offers our subscribers a powerful new tool to see the information we provide digitally in a faithful reproduction of its original printed context. To access the digital booklet, first head to the dashboard where I am already located and then click on the Investment Survey under Traditional Online Access. From there, the digital booklets for both current and back issues can be accessed. Once the digital booklet is opened, navigation is as easy as flipping the page or alternately jumping to a specific bookmark using the sidebar, which is conveniently organized by industry. On top of our regular reports, Value Line provides additional daily content on markets, and individual companies can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. I will now show you how to access these reports. First, head to the dashboard. Once again, under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to build their cash reserves over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, and among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and updating our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two key metrics that are used to calculate a stock's safety rank, an important tool to measure risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information about our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Now let's move on to the one stock to buy right now. For this, let's go first to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. As noted in our economic commentary, although the tariff situation appears to be improving, there remains a great deal of uncertainty. Accordingly, today we're going to be looking for stable, financially strong companies that are well positioned to outperform the market at large. So let's go to our first filter, and that is we are seeking a safety rank of 3 or better. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 being the highest to 5, with 1 including the most conservative issues. I want to highlight the fact that while stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. Again, we're going to focus on stocks with a safety rank of 3 or better, and by applying that first criteria, we've trimmed our potential candidates down from 5,700 to 2,147 candidates. Number 2, now we're going to filter for timeliness, and we're going to look for a timeliness rank of 3 or better. The timeliness rank is used to predict the relative 6 to 12-month performance of stocks in the Value Line universe. Format is an easy-to-understand scale from 1 to 5, with those ranked 1 likely being the best performing issues on a relative basis. Most often, buyers want to avoid stocks ranked 4 or 5, while those ranked 1 or 2 are considered above average. Today, we're looking for stocks ranked 3 or better, and applying that filter, we're now down to about 980 stocks, 960, excuse me. Number 3, the third filter is an earnings predictability score of 70 or above. You also want a stock that has relatively predictable earnings. This metric can be found in the lower right-hand corner of a stock page typically and is based on a scale of 1 to 100. Applying that filter, we find ourselves down to 398 candidates. The fourth filter is the 18-month appreciation potential, and we are going to look for such potential that it's 20% or better. We want to target equities that are likely to perform well over the intermediate term. We are going to focus on stocks with 18-month appreciation potential of 20% or better. And by applying this screen, we've chipped away the list of prospects down to 176 candidates. The fifth filter is industry rank, and this metric measures rank out of 94 industries under coverage. We are going to focus on industries ranked in the top 20, and after running this screen, this leaves us with 59 candidates. And the final filter is the beta characteristic, which we look for an interval between 0.9 and 1.0. This statistic measures the sensitivity of the stock price to changes in the overall market, and we would like to limit our selection to the less volatile equities, and this gives us our final 8 candidates. And they are Cintas Corp, ticker symbol CTAS, Encompass Health, ticker symbol EHC, WW Grainger Corp, ticker symbol GWW, Honeywell International, ticker symbol HON, Hubble Corporation, ticker symbol HUBB, KBR Corporation, ticker symbol KBR, Kinsale Capital, ticker symbol KNSL, and Leidos Holdings, ticker symbol LDOS. You can make a case for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Encompass Health Corporation. Ticker symbol is EHC. Before I click on Encompass Health, please note screens can be saved and revisited by utilizing the Create Save Screen button at the top. We'll now go to the last full-page report on Encompass Health. ticker symbol EHC. There we go. Encompass Health provides post-acute healthcare services through inpatient rehab hospitals and long-term acute care hospitals. It is the largest owner of inpatient rehab hospitals, but also has several joint ventures as well. Over 11,000 beds were operated at the end of the prior year, and nearly 65% of revenues are provided by Medicare. The stock has performed well in recent quarters, though a recent pullback presents a nice opportunity for investors to capitalize on the better valuation. Management has a solid reputation and is executing well. Demographics are a tailwind, and the relatively light industry investment of prior years should support solid demand growth for the industry's leading operator. Although we think earnings growth may decelerate in the new year, we think that prospects are attractive over the coming year and beyond. Our 3 to 5 year price target range on the stock is 135 to 200. Our stop loss is $87.02 based on yesterday's closing price. In summary, Encompass has above average earnings growth potential, which should lead to above average share price gains. It is today's one stock to buy right now. Before we go into our questions and answers session, we would like to note that we have sold our past one stock to buy right now recommendations, NICE Limited, ticker symbol NICE, and Adobe, ticker symbol ADBE, as their fundamentals and or valuations have changed since we presented on the stocks. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation. Now I'll hand it off to Nathaniel and Alan. Thank you.
Thank you, Charlie. This is Alan. The first question was, please discuss the PE ratio in more detail and how it can be useful for investing. It's a great question. The price to earnings ratio, better known as the PE ratio or just PE, is the most widely used statistic in investing. If you are like most accomplished investors, you will not make a move without knowing the PE ratios of the companies whose stocks are on your short list. In addition, you will regularly check the PE ratios of the companies whose shares you own. The PE ratio is a measure of a company's market value relative to its earnings. In the most basic terms, a PE ratio is the price of a company's stock at the close of the previous trading day divided by its share earnings. Value Line calculates the PE by dividing a stock's current price by an earnings figure that includes 6 months of past earnings and 6 months of projected future earnings. For example, let's say a company's share price is $40 and its earnings per share is $2. Its PE ratio would be 20, which is 40 divided by 2. If the company's earnings jump to $2.50 and the share price remains at 40, then its PE would be lowered to 16, a more attractive scenario in this case. There is no right or wrong PE. Expect to pay a higher price and accept a higher PE for companies whose earnings are accelerating. The opposite is true for companies whose earnings are flat or growing slowly. If you believe that earnings are poised to take off before the market recognizes it, and the company is maintaining its current PE ratio, you may want to buy now in anticipation of a future earnings jump. In fact, depending on your tolerance for risk, you might be willing to pay a relatively high price for a stock with low or even no earnings in anticipation that it will be a standout moneymaker in the future. On the other hand, if our analyst projects continuing growth for a company but its PE is already high, you may want to wait for a pullback in price before committing funds so you don't have to pay more than you want based on the total return that you anticipate. You also find a trailing PE and a 10-year median PE in our data. The trailing PE does not consider future earnings. It divides the stock's previous trading day's closing price by the most recent 12 months of actual earnings. The next question was, Could you describe the timeliness ranking system in more detail? The Value Line's timeliness ranking system measures predictive relative price performance of the approximately 1,700 stocks during the next 6 to 12 months on an easy to understand scale from 1 highest to 5 lowest. Components of the timeliness rank include such items as the trend of relative earnings and prices and earning surprises. All data are actual and known. A computer program combines these elements into a forecast of the price changes of each stock relative to all of the approximately 1,700 stocks for the 6 to 12 months ahead. Subscribers should focus on companies that are ranked at least 3 or better for timeliness. We update our timeliness ranks weekly, so investors should pay close attention to stocks they are interested in. There's another question regarding Encompass Health in particular. What factors do you think will drive Encompass Health's profits next year and beyond? There are several key growth drivers for the company in our mind. Capacity expansion in new facilities. Encompass Health's growth strategy centers on increasing its capacity to meet the high demand for inpatient rehabilitation services. The company should also benefit from new hospitals. In fact, the company plans to open 6 to 10 new hospitals per year through 2027, with 13 slated for next year. There should also be bed additions. Encompass Health is adding 80 to 120 beds to existing hospitals each year, which enhances capacity in already established markets. The company is also taking advantage of joint ventures. Favorable demographics. The demand for Encompass's services is significantly driven by the ongoing surge in the 65 plus population, who are the primary users of inpatient rehabilitation care. This demographic tailwind creates a persistent high demand for their core services. Increased patient volume of discharges. The expansion efforts are expected to lead to a continued strong discharge growth, both from new facilities and existing ones, thereby capturing significant incremental patient volume. There's also should be increases in operational efficiencies and pricing power. This is due to reimbursement rates. The company benefits from favorable pricing trends, including anticipated Medicare price increases and managed care price rises, which are factored into financial projections. Cost management. Encompass Health has demonstrated improved labor cost management, with salaries and benefits decreasing as a percentage of revenue. Also, infrastructure upgrades. That's part of their long-term strategy, as is technological integration, investments in technology, such as new systems, predictive analytics, and digital health tools, aim to enhance patient outcomes and operational effectiveness, further solidifying its market leadership. Thank you.
I think that's all the questions. So, yeah, unless you're seeing anything else.
That's all I see. I thank you all for joining us, and we'll hand it back to DJ.